Good day, thank you for joining me. I'm Ryan Kun. I'm going to be taking you through Tiger Brands half year 2019 results. Tiger Brands is a high quality food producer with a strong balance sheet and sound cash generation. The group has an attractive portfolio of leading brands with good spread across market segments. Earnings have been under pressure recently, primarily due to the impact of the listeriosis outbreak on its VAMP business and the difficulty on passing on cost inflation given the tougher macroeconomic conditions. Volume growth is expected to remain constrained against the backdrop of a weak consumer spending and additional operational efficiencies becoming essential to sustain earnings. The group has seen working capital improvements, which would feed into greater free cash flow generation. This, coupled with no debt, indicates that dividend payments should be sustained while maintaining a strong balance sheet. Market share gains have been seen across key segments, resulting in further strengthening of the brands in tough economic times. The VAMP segment is expected to stabilize over the next year, with factories starting up again and adding to production. Operating margin and ROE are currently depressed and well below historical averages, with reversion expected. However, gains are expected as management's strategic objectives begin to take form. We feel the share offers value to long-term investors and estimate that cyclical headwinds are fairly reflected in the current valuation. The share is trading on a PE multiple in line with its long-term average, but with earnings on a low base. The stock currently trades on a dividend yield of 4.6%. We therefore recommend an overweight position relative to the JSE Capstrex Index. Looking at a few financial highlights. Results have been complicated by the sale of Oceania and the VAMP listeriosis shutdowns. Revenue decreased by 2%. Excluding VAMP revenue had increased by 4%. This was impacted by lower volumes and low price inflation. Gross profit margins decreased by 195 basis points to 31.3%. Adjusted operating profit fell by 13%. Excluding VAMP, adjusted operating profit fell by 9%. Strong volumes were recorded in beverages, home care, baby care and groceries, which were offset by a decline in grains volume. All categories except sorghum-based products, maize, pasta and baby care recorded selling price inflation. However, these price increases were not enough to negate the rising production costs from power outages and strikes that continue to interrupt operations. Adjusted headline earnings per share, excluding VAMP and Oceania, decreased by 9% to 831 cents per share. The group declared an interim dividend of 321 cents per share, down 15% from the prior period. This was a result of the group changing its dividend policy to 1.75 times. A special dividend was declared of 306 cents per share. This was a result of the once-off proceeds received from the Oceania sale. Onto the cash flow. Due to the cyclical nature of the entity, a significant portion of cash flows are generated in the second half of the year. As a result, we have analysed year-end cash flows. Cash generation is consistently stable and positive. Tiger Brands is able to generate sufficient cash flow to sustain the dividend into the future. Currently, the group trades on a dividend yield of 4.6%. Looking at prospects. Management expects the consumer environment is unlikely to improve, while low price inflation and lower volumes will adversely affect revenue. By 2022, management anticipates net sales growth of between 1% to 2% from a base of 30.6 billion rand in 2016, gross margin growth of 150 basis points to 180 basis points from 32% in 2016. Marketing investment growth of 100 bips to 160 bips and a return on average net assets of greater than 35%. If you would like to place a trade, please speak to your financial advisor or contact the trading desk. A comprehensive company analysis report on Tiger Brands can be found on PSG Wealth's online trading platform. Before we end off, please take note of the following disclaimer. Thank you.